Welcome to Potentia Wealth's Mid-Year Economic Outlook. My name is Kevin Swanson, and I'm the CEO of Potentia Wealth. As part of our ongoing communication to and education for our clients, we continue to bring industry thought leaders, economists, and fund managers to provide perspective into the world we live in today and how that will impact us individually. We have been providing our clients economic outlooks for over 15 years, and our client base has grown in sophistication and geographic territory, so our presentation has also continued to adapt. This is the first year our economic update is online only, as Potentia Wealth is now serving clients in over 25 states and internationally. Today, we'll be hearing from Jack Manley. Jack is an executive director and global market strategist on the JP Morgan Asset Management Global Market Insights Strategy team. He's also been a frequent guest on CNBC, Bloomberg, BNN, and other financial news networks, and is often quoted in the financial press. Jack joined JP Morgan in 2013 as a member of the Asset Management Strategy and Business Development team, where he worked on various strategic initiatives across the firm, and has been in his current role since 2016. Welcome, Jack. We've just gone through or past Valentine's Day, the day of love. Is there anything in this economy we should love at this point?
Kevin, I like that introduction. That's a good way to think about this because, to your point, right, there is a lot of bad news out there. There's a lot of noise that we have to kind of sift through. But there is, I think, some good stuff out there to talk about. There is some stuff to love in today's economy, in today's capital markets. And so what I'd like to do over the next 20 minutes or so is kind of give my high-level assessment, my overview of what's going on from a macro and markets perspective. So talking about the economy, talking about the markets, talking about stocks, talking about bonds, talking about the US, talking about the rest of the world, kind of running the gamut over this time together, and hopefully addressing any questions that may be floating out there about how to think about today's admittedly very challenging landscape. And to do that, I'm going to go through a handful of slides from our flagship publication at JP Morgan called The Guide to the Markets. So with that, let's turn to the first page of this presentation. Always think it is helpful to start by talking about the state of the US economy. If you have a view on how the economy is doing, it's a lot easier to have a view on how stocks may perform, how bonds may perform. And from an economic perspective, there are a couple different questions that are out there right now that are getting asked, but I think the biggest one is the question around recession. Right? Are we heading into a recession? When is a recession happening? Isn't it imminent, right around the corner? And look, this is an important question to answer, certainly, and I get why people are asking it, but I do think it's important to step back for a second and reflect on this fact that we've been having the same recession conversation for the last 13 months. Right, we've been talking about a recession in the United States as if it were inevitable for more than a year at this point, and yet here we are in the early part of 2023, and no recession has materialized just yet. You know, we have to acknowledge there are some pretty serious structural drags on this economy, structural drags that will persist through 2023. Housing market has slowed down because of what's gone on with mortgage rates. Business investment, consumer spending lower because of what's going on with broader interest rates. Massive fiscal drag on this economy because the Congress just isn't spending as much as it did in the immediate aftermath of COVID. And a very significant trade deficit that drags on economic activity, driven mostly by a very strong US dollar. But like I said, right, Kevin, there's still a lot to love out there. There's still some stuff that is worth talking about. We have income levels that are trending higher, consumption levels that are trending higher. And if you look at the most recent employment report for the month of January at over 500,000 jobs gained, very clearly the labor market continues to be quite healthy. None of that sounds particularly recessionary. So unfortunately, for those of us that are looking for that clear kind of black or white answer to the recession question, you're just not really going to get it. There's too much gray area. There's too much nuance right now. And frankly, when it comes to the recession outlook, I kind of flip a coin, heads or tails, not quite sure where it's going to land. But I think whatever you want to call it, right, recession or not, very clearly we are heading through a slowdown. Economy slowed down last year relative to the year before. This year, it will likely continue to operate at a suboptimal pace. So what I think is worth trying to figure out is, well, just how bad could this slowdown be? And that's where page 20 from our Guide to the Markets comes into play. It's a page that looks at the cyclical sectors in the US economy, the most volatile parts of the US economy. Housing and business spending up top, vehicle sales inventory numbers on the bottom. Now take a look at what's going on with some of these indicators leading up into previous recessions. Look at what's going on with residential investment, the housing market leading up into the financial crisis. And look at what's going on with business investment leading up into .com. Right, these are very clear areas of excess, of overextension in this economy. These are bubbles, and bubbles always burst. And when they burst, the pendulum swings in the other direction. You go from boom to bust, and you get a recession. Now compare that to where we stand right now. The story is a little bit different, right? None of these indicators are screaming overextension or screaming excess. They're all more or less in line with their long-term averages. You know, we like to say that it's hard to hurt yourself falling out of a basement window. Think about that analogy as it relates to what's going on with growth. Right? If there are no massive imbalances, if there's nothing booming right now, where's the bust going to come from? There's no bubble that's going to get burst. And while I don't want to sugarcoat the growth outlook, it's not a good one, right? All those structural anchors that I mentioned earlier are still very much relevant to the story this year. It's not as bad, I think, as what confidence numbers may tell us, as what some of the volatility in the equity market may tell us, or certainly what the last two recessions have told us about what a recession feels like. So the growth outlook, it's not great, sure, but it's not awful either. And I think that's reasonably encouraging given everything that's happened over the last 13 months. Now, if we flip forward a page, we can shift our focus and talk a bit about inflation, because that, of course, is going to be the other big macro force that everybody wants to talk about. And this morning, we got another inflation print, this time for the month of January. 6.4% year over year headline CPI growth. Now, that was a little bit more than what we were looking for. Consensus was for 6.2%, but 6.4% is still a not so bad figure, because what it does is confirm that we now have 7 consecutive months of inflation that have come off of the high that we achieved in June of last year. You can see June of 2022 was 9.1%, the highest reading we've gotten since 1981. Every single print since then, including this morning's, has come in softer, not just relative to that print, but relative to the one before it. So 6.4% for January, just a little bit softer than the 6.5% we have here for December. What's interesting is if you look at the left-hand side of page 30, you will see that the forces driving inflation have shifted over the last 12 months. It used to be much more supply-driven, things like energy, food, vehicles. And that's because we had pretty significant supply chain issues this time last year. Right? Russia had just invaded Ukraine, both of those countries very large producers of food and fuel products. China was maintaining a zero COVID tolerance policy, making it very hard to get a hold of finished goods, including vehicles. But those stories are not top of mind anymore. Right? The energy story is not quite as relevant. Food's not quite as relevant. Vehicles not quite as relevant. Inflationary forces have shifted from supply to demand. And now we're looking at things like transportation, hotels, restaurants, shelter, and other services. And so when I think about what the outlook is for inflation, the kind of trajectory for inflation, I do think this trend continues. I do think that inflation continues to move lower as we move through the first half of this year. But because of the composition of inflation and because so much of it is demand driven, I do think we have to recognize that getting back to where we were pre-COVID from an inflationary perspective is going to be very, very challenging. There are sticky things going on in the inflation world right now. Wage growth, as an example, running at multi-decade highs because the labor force is 2 million people smaller than it was just a few years back. Businesses are being forced to pay more for the same talent because how else are you going to retain or attract these individuals? And when we think about what's going on with shelter, well, sure, home prices have fallen off because of the impact of higher mortgage rates. But if you are someone that's priced out of home ownership, your only alternative is rent. And so rent moves higher as home prices move lower, and rent feeds through into these inflationary prints. So I do think inflation is going to come back down to something more comfortable by the time we hit the first half of this year. but it's not going to be 1%. It's not going to be 2%, maybe closer to 3 or 4. Better than where we are right now, different from where we were pre-pandemic. And it brings us now to the next page here, which is to say, all right, you got a view on growth, you got a view on inflation. What does all this mean from an interest rate policy perspective? What's the Fed going to do about it? And this is a really difficult question to answer, because I don't think the Fed itself fully knows what it's going to do about it. Over the last 12, 13 months, the Fed has consistently moved the goalposts. It keeps telling us it's going to hike more than it had told us in previous months. As of right now, the overnight federal funds rate range is between 4.5 and 4.75. That is as high as it's been since the financial crisis. The Fed itself is telling us to expect 50 basis points more of interest rate hikes this year. That likely means 25 basis points in March, followed by 25 basis points in May. That would bring the overnight rate to the highest level we've seen since basically the early 2000s. Now, if you look at the right-hand side of page 34, you'll also see a green line. That represents what the market is expecting. And you'll see that the market is not fully buying what the Fed is selling. There's a divergence in these lines. The market doesn't think we're going to end this year with the same rates that the Fed is telling us. Now, to the market's credit, or to the Fed's credit, I guess I should say, the market has been consistently wrong about what's going on with interest rates for the last 12, 13 months. So I don't put too much faith into that number. But to the market's credit, right, I would like to say that, hey, the Fed keeps moving the goalposts, as I said, so it's really hard to try to figure out exactly what's going on with rates. We're looking at an economy that is very clearly slowing down. We're looking at inflation that now has pretty sizable evidence of cooling off. You may wonder why we are in the midst of the most aggressive rate hiking cycle we've seen in decades. And hey, I think that's a fair question. So I kind of split the difference here. I'm not saying we're done with rate hikes like maybe the market is expecting. I'm not saying we're going to get a cut by the end of this year, which is maybe what the market is expecting. But I don't know if we necessarily go for a full extra 50 basis points. Let's call it one more 25 basis point hike in in March, and then a pause. Wait to see what happens. Unfortunately, though, I don't have a lot of conviction in that view, right, for all the reasons that I've already talked about. So what I'd rather say is that we're almost certainly getting at least one more interest rate hike. And that perhaps most important, we are far closer to the end of this hiking cycle than we are to the beginning. And that's going to have, I think, a lot of implications for when it comes to how we allocate our assets. So if we turn to the next page here, let's talk a bit about what's going on in the bond market, because that, I think, is top of mind, given that it is so closely related to what's going on with interest rates. For a lot of folks, they may feel like bonds betrayed them last year. The bonds are broken because you're not supposed to lose double-digit percentages in high-quality U.S. fixed income. It's a bad year in the equity market. It's not a bad year for bonds. But I don't think bonds are broken. I think bonds actually play a very important role in portfolios right now. And for the first time in decades, you're getting both income and protection. No one's going to be upset about clipping 4.5%, 5% on risk-free U.S. paper. That's pretty healthy. Nice coupon to keep that income stream afloat. You don't really have to extend duration. You don't really have to look down in the credit quality space. Income's pretty easy to find in fixed income. And I really like the right-hand side of page 37 because it illustrates how duration protection can play a role in your portfolio. What we do is we model out the impact of a 1% rise or fall in interest rates. And what that does, the total return of all these different fixed income subsectors. Blue bars are what happens if rates are falling. Gray bars are what happens if rates are rising. And the nice, easy visual cue here is that, hey, the blue bars are bigger than the gray ones. I don't know exactly where the Fed is going. I don't know exactly when it's going to get there, but I do know that after all the chaos we experienced last year, there is more upside potential than downside risk in bond markets today. And if the Fed is forced to cut interest rates for whatever reason, duration in your portfolio, like the 10-year Treasury or the U.S. aggregate index, that'll help to keep that portfolio afloat. So a good risk-reward profile that exists within fixed income right now, and finally an asset class that is delivering both income and protection to portfolios. Perhaps the most exciting time to be a bond investor in almost 20 years. Now, if we turn to the next page, we can shift our focus and speak a bit about what's going on in the equity market. That is probably most top of mind for a lot of the folks on the line. Clearly, its own fair share of problems, right? But I do think when we're looking at the equity market, there is good news, good-ish news at least, and then there is some bad news. It's a more nuanced story, I think, than what we're talking about in bonds. The good news first, right? Which is to say that roughly this time last year, maybe a little bit earlier, the only thing we could talk about when it came to US equity market was how expensive it was. Stocks were trading at north of 22 times forward earnings. You'll see on the right-hand side of page 5 that that is as expensive as stocks had been since the dot-com bubble. We all know how that turned out, right? So this time last year, investors are looking at the market and they're saying, well, hey, how could things get anything but worse from here? And they ended up being right. Federal Reserve starts hiking interest rates aggressively to fight multi-decade high inflation. And in doing so, it crushes multiples. It crushes valuations. We go from trading at 22 times forward earnings to 16 times forward earnings. And the good-ish news, right, is that after all this pain that we felt last year, well, at least stocks aren't that expensive anymore. We've seen a little bit of reflation recently in multiples. We're still a little bit above that long-term average, but far off of those highs where we were at the end of 2021 at the beginning of 2022. So the good news again, right? Good-ish news. Stocks aren't really expensive. Don't have to worry much about that. There is bad news though, and if we turn to the next page, the bad news is the earnings story. If you look at the right-hand side of page 8, you will see that 2021 was a banner year for corporate profits, 70% year-over-year earnings per share growth. But you will also see that the majority of that earnings is coming from the gray bar, from margins. Companies getting really lean, really profitable in the aftermath of COVID. And we are making our way through the fourth quarter earnings season from last year. It's almost wrapped up. And very clearly, that story has not been maintained. Wages are higher, rates are higher, input costs are higher, and as a result, margins have compressed. And while they are compressing, the economy is slowing down. So we are not calling for 70% earnings growth for 2022. We're not even calling for double-digit earnings growth or even positive earnings growth. We're looking for a modest contraction of 5% in earnings in 2022. And my guess is that a lot of those headwinds that we faced last year, we will continue to face this year. It's going to be hard to make money in the equity market this year. But if we look at the next page, while it may be hard, it is not impossible. There are a few different places that I think we should be looking at as investors, especially over the short term. I mentioned stocks aren't that expensive anymore, and that is good news, but some of us are still looking for bargains. And if you look at the left-hand side of page 10, you'll see that value stocks are trading at roughly a 40% discount relative to growth, way cheaper than the long-term average. You're looking for income outside of the bond market. You'll see in the table on the bottom left side of page 10 that the dividend yield for value stocks is more than double what you get out of growth equity. And if you're trying to figure out how a company can possibly make money in what is very clearly a challenging macroeconomic backdrop, look at the right-hand side of this page. Operating leverage by sector, all that means is the impact of a 1% rise in revenues on your profits, on your earnings, on your bottom line. Three sectors jumping off the page here, right? The clear outliers: energy, financials, and materials. You'll see those are gray bars. It means they are value oriented. So you want to put this very simply, there is value to be found in value. But I am not telling you that we are on the cusp of some big shift where value is going to outperform growth over the next 10 years. This is short term, it's tactical, it's opportunistic. We need to match it with something longer term and more strategic, and that is, I think, growth. And in particular, tech and tech adjacent names. This stuff's not going anywhere anytime soon. The difference is that growth at any price investing is dead for as long as interest rates are off the floor. But growth at a reasonable price investing still very much in the cards, on the table as a viable investment philosophy. So ultimately, as US equity investors, the name of the game is balance. But if you look at the next page, we also can take this time to zoom out a little bit and think about the equity market holistically. We know that in January of last year, the S&P 500 peaked at 4797. You look at the left-hand side of page 16, we know that we're about 700 or so points off of that high. We also know that we are going to get back to where we were in January of last year. It is an inevitability. It's just a matter of how long it takes. And so what we do on the left-hand side of page 16 is we show what happens if you put $1 into the equity market today and then ride the recovery train back to where we were in January. You think it's going to take a year? That's almost 20%. You think it's going to take 3 years? It's about 7% per year. 5 years to recovery, that's still about 5% per year. These are good numbers. No one's going to be mad about those returns in their portfolios. I can sleep easy at night knowing that $1 that I put into the market today is going to work extra hard for me in the future. And while we can argue about whether the next interest rate hike is 25 basis points or 50 basis points, or if the next inflation print is 6.3 or 6.2, at the end of the day, it's all just kind of noise. This is the big picture story, the holistic view. And just as within the bond market, I'd say there's more upside potential than downside risk in stocks. Now, in the spirit of talking holistically, let's turn to the next page here and talk a bit about international economies and markets there. That's been a challenge recently, especially as longer-term investors. We've been talking about international being the thing to drive portfolio returns for the last 15 years, and it just hasn't happened. We're paying too much attention to valuations in this space and not enough attention to everything else. So when I think about investing in international assets, there are a couple of different ways that I want to approach it. The short-term story is the developed world. And in that case, we want to focus in on two things. The cyclical upswing that we are seeing as the world starts to recover from where we were last year, and then a thematic story. So we talk about the cyclical upswing. Let's look at this page, Purchasing Managers Indices, or PMIs, a measure of economic activity. The easy way to read this is that anything above 50 is good, and that green is good, right? Nice, easy way to read this page. You look at the most recent PMI readings for January, you will see that the US is contracting and a lot of other places around the world are starting to expand. There is a divergence in growth right now. Economies around the world outside of the US are starting to pick up, and these markets are much more cyclically oriented. Much more exposure to things like industrials, materials, financials, energy, the stuff that we think may work right now, and less exposure to technology. So the cyclicality in developed markets works. We also like the thematic story there. What does Europe do very well, for example? Luxury goods. So you approach developed market investing, focusing in on cyclicality and on themes. Now it starts to make more sense. But just as within the US, right, you got to strike a balance. And so there is a long-term allocation there as well. And that to me is the emerging world, particularly EM Asia. Heavy exposure to manufacturing, exposure to the consumer, large, rapidly growing middle class. And that brings me now to the last page here, which will be page 61 from our guide to the markets. Looks at asset class returns going back 15 years across a bunch of different things, right? Stocks, bonds, international, US, high quality, low quality, small, large, whatever you may be looking for. Now, I just spent the last 20 minutes or so going over my high level views for what may happen with growth, with inflation, what the Fed may do about it, where the risks and opportunities may lie in global stock and bond markets. But as I said a few times earlier, I think at the end of the day, I just don't know. I don't have a crystal ball. I cannot tell you exactly what the future is going to hold. And no one 3 years ago was pricing in a global pandemic. No one 2 years ago was pricing in war in Europe. Stuff happens very, very quickly, and it can turn the outlook on its head. You can see on page 61 that it is impossible to predict what the best or worst performing asset class is going to be in any given year, because it is impossible to predict what that next big source of volatility is going to be. But you know that there will be one. You know there will be more volatility. You know something is going to happen. And so instead of trying to predict what it will be, you prepare for it. And you do that through diversification. Owning a little bit of all these things that we just talked about across styles and sizes and sectors and asset classes and geographies, and put together a nice little asset allocation portfolio. And you look at this page of those light gray boxes, you will see that in any given year, asset allocation is not cool. It is never the best performer. It will never knock the cover off the ball. You will never be at the top of the league table in any given year as an asset allocator. But I think that that's okay. Because for most of us, we are not day traders. We are not chasing performance. We are long-term investors looking for long-term investing success. And if that is the mindset, then we have to remember that the journey is oftentimes just as important as the destination, and diversification is what gets us there. So I want to thank you all very much for the time, consideration. It was a pleasure being here. I hope this was helpful. Pass the call back over.
Yeah, thank you, Jack. Craig Pine and I'll have a couple of questions for you. I'd like to start off by looking at page 34 again, where we talk about the market hope versus the Fed expectation of where interest rates will go. There's definitely a difference there, with the market hoping that we see interest rates increase, a little bit more and then drop off. Is that going to have a short-term impact in the stock market?
I think it might, Kevin. The problem with the stock market right now is that it is banking on a lot of good news, and it is seeing through a lot of short-term chop. The big issue that I would say the stock market is not fully accounting for is what happens if we do get a recession, and what that recession may mean in terms of our ability to consume. Because we can say that multiples have deflated quite a bit. We don't really have to worry about that so much anymore. We know that margins have moved down considerably because costs are higher. But the one thing that hasn't budged yet is the revenue side of things. So how is that going to hold up in a recession? And whether or not it's a mild recession or a severe recession doesn't really matter. Top line growth will fade in the event of an economic slowdown. And I don't think markets are fully pricing that in just yet. Rates are going to be a part of that story. But at the same time, does it really matter? If this is a short-term recession, if it's short, if it's mild, if it's mellow, if we dig ourselves out of it by the back half of this year, the stock market is inherently forward-looking. And whether or not we get a cut in December of this year or a cut in January of this year or of next year, I don't think it changes the overall story, which is that there are still some pretty significant dislocations in the equity market that can be taken advantage of. So yeah, this is an example on page 34 of where you may get a little bit of short-term chop, but I think if you keep your head down, you can see through it pretty easily into the other side of all this.
Jack, a question for you, but for those of you who don't recognize me, my name is Craig Pine. I'm a senior advisor at Potentia Wealth Management. I've been around for about 10 years. So thank you for your time. Hey, Jack, I want to go back to international. I want to drill down on that a little bit along the lines of Valentine's theme and love and not being loved. Up until the last 90 days, international really hasn't been all that loved. However, those benchmarks have really done well over the last, 3 to 4 months. Can you drill down on what's behind that a little bit and maybe some specifics?
Sure. So there are a few things that I think are contributing to the international outperformance. I think one of the biggest ones is that the U.S. economy is more fragile now than almost any other economy around the world. We were really worried about international performance last year because of the impact of the war and what that did to commodity prices and how that would impact Europe in particular. But Europe's gone through a much milder than expected winter, which means that their commodity needs were not as intense, which means that they were able to continue to consume on other fronts. So you have the U.S. economy that is grappling with higher interest rates after having been reopened for the last two and a half years at this point. And we can see very clearly on this page, right on page 51, that the US economy is slowing down, the other economies around the world are picking up. That is helping the international story. We've also seen the dollar depreciate over the last 90 days or so. Dollar was on a tear last year because of geopolitical issues and also a widening out interest rate differential, in the sense that the Fed's hiking rates, but no one else is really catching up. Well, now the dollar has turned over. Geopolitical tension's still there, but not as relevant, not at a boil, maybe just simmering. The interest rate differential has narrowed a little bit. The dollar has given up some of its gains. That's good for international investing. And I guess the last thing I'd say, Craig, is that coming into this period of international outperformance, international markets were just so darn cheap that it got really, really hard to ignore that story when you paired it with this cyclical upswing and the downward move in the dollar. So I think you take these three things, you put them together, it makes it a little bit easier to understand why international has done so well over the last 90 days, to your point.
Thank you.
Jack, I'd like to go back to page 30 for a minute, and you were talking about inflation and how we continue to see that declining. Yet on the headlines today, it said that January CPI has increased, not decreased, and that the Bureau of Labor Statistics on Friday had changed December's numbers from a slight decrease to a slight increase. Can you help me understand, help my clients understand the juxtaposition between those two?
Yeah, that's a very good question, Kevin. So when we talk about the increase in prices, it is on a month over month basis. So comparing what January prices looked like relative to December prices. The headline figure that we typically quote of 6.4%, for example, is a year over year price. So that's January of this year relative to January of 2022. Now, if you want to dig in a little bit to the CPI print this morning, there were three big things that I think we were looking for coming into this print. The first one is that we were expecting month over month prices to increase. That was not a surprise. We were expecting that to happen. The second is that we were expecting that increase to be driven chiefly by increased energy costs, increased food costs, and to some extent, increased shelter costs. Those three things happened exactly as we were expecting. So that was not a surprise. And then finally, and I think probably most important, despite all that stuff, we were still expecting inflation to move lower from 6.5% to something below that. And while it may have surprised us at 6.2% or 6.4%, that is still lower than 6.5%. So directionally, we're moving in the right direction there too. So I don't think there's too much you need to get worked up about when it comes to this morning's inflation reading, especially because food, fuel, the stuff that's feeding through into some of these numbers are inherently volatile and very, very difficult to control. Doesn't make it easier for us as consumers, right? I mean, nobody likes paying more for groceries or more for a gallon of gasoline, but it's not necessarily a macroeconomic indicator that the Fed may pay attention to. The Fed's looking at, I think, a whole lot more beneath the surface. But I guess the other way I'd frame it is that it is evidence, right, that while there is this downward pressure on inflation, it's going to take some time for this number to really meaningfully move lower. We should not expect inflation to drop from 6.4% to 2% by March of this year. That's just not going to be the way that it works. It's a gradual process. There's a lot of room for volatility in the short term. We may see some more upward pressure before we see continued downward pressure, but I do think the trend that has emerged is very encouraging, and I wouldn't put too much stock into any one particular print, especially the one that we got this morning.
Thank you.
Hey, Jack, I always like to ask our guest this question, which is, if you set aside the guide to the market and set aside your JP Morgan hat, if we were just out having a beer, maybe it was our second beer, what would you bring up as that classic black swan event, or something that's lurking out there, the elephant in the closet that no one's thinking about? And feel free to take as much liberty and latitude as you would like in your response.
Yeah, well, thanks. That's a good one. I wish we were having beers over this one. It would definitely make it easier. I don't want to say that nobody's thinking about it, because I know people are thinking about it, but I do think geopolitics are very, very important, and they are inherently unpredictable. You know, there is sort of, it's not even a détente right now, but you're just not hearing as much about what's going on in Ukraine as you did a year ago. That could very easily escalate in a very big way that a lot of us just don't want to think about. I think another similarly challenging, potential black swan is what's going on with our relationship with China. You know, you hear about these balloons getting shot down and unidentified flying objects and tit for tat exchanges of missiles and that sort of thing. And what does this mean for U.S.-Chinese relations? What does this mean for Taiwan's existence as a theoretically independent nation within the next 5 years or so? So geopolitics definitely keep me up at night. They are very, very hard to account for, which is why I don't spend too much time talking about them in presentations, because, what do I know? I have no idea what Xi Jinping is thinking. I have no idea what Vladimir Putin's thinking. It's not worth, I don't think, trying to game that out. But those are a couple of things that I'm definitely paying attention to, Craig, that I think could rock the boat a little bit. I guess a more realistic or a more tangible issue that we could face is, what happens if the Fed is forced to continue to raise rates beyond what we're expecting, because some of these inflationary components are stickier than we are expecting, and say mortgage rates move higher than we would have liked, and all of a sudden housing prices fall lower and our ability to consume gets diminished, and we're getting squeezed on all sides, and we have looming geopolitical issues, and then you start to perhaps see this world where the recession that we end up going through isn't as mild as we would have liked, and it's actually a lot more severe. It's not the base case, but I can see how we get there. It's not that difficult to figure out how you get to that place where it's a pretty unpleasant recession. It may take a while for us to dig ourselves out of it. So that, I think, is also something worth considering, that I can be an optimist and I can have a glass half full attitude and I can tell you what my base case is, but there's a lot of wiggle room on both sides. There's a lot that can go wrong that would pretty significantly change the outlook here. So that's, I guess, the other way I'd answer that.
Excellent. And you know what, Jack, I'm really glad I asked that question. And on that question, we're going to go ahead and wrap up, because we're right about the 30 minutes that we like to keep these to. I wrote down some notes and I had some key takeaways. You started off by talking about lots of gray areas and nuances. And the word we use is, uncertainty. And our clients have been well educated to the fact that markets don't like uncertainty. And while there's always plenty of it out there, I feel as if there's less today than there was a year ago, whether it be inflation and feeling like we've got it under control. I don't know if this is proper to say, maybe, the war in Europe is somewhat contained. We can have some visibility or line of sight on where the rates will stop being raised. So a little less. Again, there's always plenty. It's just a matter of degree. The second thing I took away was a recession is not inevitable. As you pointed out, we've been talking about this for 13 months. In fact, I saw a headline in the Wall Street Journal yesterday, because in our business, and maybe for our clients, they can relate to this, they talk about, can Jerome Powell and the Feds deliver a soft landing? Well, maybe there's not going to be a landing at all, because there ain't going to be a recession, right? And so that was a key takeaway for me. And also, lastly, is while the outlook for growth is not great, it's also not horrible. So thank you for summarizing that in such a great way. Lastly, I want to extend some thank yous. First of all, to Jack Manley and Kevin Cruiser from JP Morgan. I know that both of your calendars are full and lots of demands on your time. So thank you for making yourself available to our clients. Appreciate it. Number two, Potentia staff. These things don't happen accidentally and without planning, especially Crystal Cervantes, who, for her technical assistance, because had that been left to Kevin and I, this may not have happened properly. So thank you, Crystal. And lastly, and most importantly, to our clients for continuing to participate in our, not only our full year outlooks, but our mid-year outlook. I hope you enjoyed the new format, as Kevin outlined, based on the growth of the business and the diversity, geographic diversity of our clients. We felt this was best suited to deliver it to as many eyeballs as possible. So thank you, take care, and be well.